The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Hello and welcome to the Become a Pro course overview here, presented to you by Forex.Academy. I am, of course, your host, Robert Blackwell, and have the pleasure to walk you through tonight's education. Of course, we'll be going through technical analysis number 1. Of course, we'll be following on with technical analysis number 2. So evidently, this is lesson or webinar 10 here as we approach halfway, just after halfway point of our Become a Pro course. So I hope we're all enjoying at this stage. And tonight's particular webinar, we're going to get into a lot of detail with technical analysis. It will be quite heavy, so do enjoy the lesson and of course ask questions throughout. Of course, there is risk inherent in trading the financial market, so do have a quick consultation with the following disclaimer. And of course, just a few pieces of housekeeping before we begin tonight's live webinar. Of course, feel free to ask questions throughout there. It is a fully interactive webinar. You can even stop me as we go through some of the topics to discuss and ask questions. You have a chat box there located on the right hand side of the screen. So if you'd like to ask some questions there, you can of course do so. I'll be able to see them here in office and consult in reference to your questions there as they come up. This live webinar is being recorded and will be placed into your members area once we have concluded. So if you could just give us a 1 or 2 hour grace period to prepare the download for you, it will be placed into your members login area for revision then. And of course, we host a quick sort of 10 to 15 minute extended Q&A session at the end of each live webinar to go through some of the key talking points and topics and addressing some of the main issues some of our students of the markets may have. So we are, of course, approaching, halfway. We're just after halfway point. Of course, we're with overview here, week 3 of the Become a Pro course. Just to recap there, we went through a lot of analysis there, more particularly focused on price action itself, examining the theory and practical and historical context of price action analysis was, of course, the last lesson. Very enjoyable last lesson. I know I got superb feedback from that, so that was great. Over the next 2 lessons, we'll be jumping into technical analysis 1 and 2. So really building upon technical indication with statistical measurement and looking at trading opportunity. And then we'll be building upon some theoretical technical viewpoints, including Dow theory and Elliott wave theory and technical trading strategy as well. So very enjoyable, and obviously if you're looking to become a technical trader, well, this is for you. So let's move on then to today's lesson, of course, by first approaching some of the common technical indicator mistakes. Okay, so I wanted to bring this to your attention just at the very beginning of today's live webinar as we go through this technical analysis on the various indicators that you can use. Of course, we won't be able to cover them all in this lesson. Again, we'll have a consultation with tomorrow's lesson and really go through a lot of the finer detail. But this will give you a good idea to how to use many of the technical indicators to the best of your ability. Now, let's address some of these, I suppose, beginner or common mistakes that many traders make. They overload their screens with technical indicators, so please don't do that, guys. Of course, you're looking to provide signals. You're not looking to clutter up your screens or confuse yourself. So often people think, well, look, if I can have 10 different indicators tell me this and that, I can have a better inclination of the market. That is not the case. We look to supplement our trading ideas with technical indication to add probability to the thought, and then we trade as such. If we have 10 different indicators on the one screen, they're likely going to be very conflicting. They're going to provide us with some good indicators, but some false indication as well, and it is going to confuse our overall trade idea or setup that we view. So don't overload your screens with technical indicators. Only display the indicators on the charts that you will actually use. Remember, indicators are an indication of something happening in the market. They are not a clear prediction of the future. So we're assessing price, we're assessing perhaps volume, we are assessing movement and momentum. We're not evidently assessing what is going to happen next. Of course, that's the objective, but our assessment is to current price action to give us an idea to areas in the market where we're not likely to see trading, where we're likely to see trend continuation, and so forth. Don't blame the indicators when a trade does not work out. No matter which indicators you use, you still need to learn how to take losers in trading. And that's absolutely the case. You just need to learn to take losers, and don't blame the indicators, of course, if they don't work out. So let's jump across to developing our trading methodology. Of course, what we finished off with in the entirety of context of yesterday's live webinar, Become a Pro course webinar number 9, we focused a lot on price action and historical context as technical analysts. So this will help us build in a bigger picture of looking to trade completely as a technical trader. Developing this technical methodology takes a lot of work. Okay, so some indicators tend to identify opportunities in range-bound markets, others identify opportunities in trending markets. Leading indicators work especially well during periods of sideways market movement, and this is due to the fact that many leading indicators are oscillators. So it's important to know which type of indicators you're going to use. Of course, there are leading, there are lagging, and which ones suits the style or type of trade you're going to place. And again, in sideways markets, however, lagging indicators are almost useless. Since the market has no clear direction, they can often provide random indications completely. None of these indications, however, can make for valid predictions about future price movements. Now, isn't that entirely logical when we say to ourselves like that? The market has no clear direction. We're using a lagging indicator on price. Perhaps, a moving average is, of course, a lagging indicator, more specifically over longer time periods with the sample. Of course, if the market's just trading sideways, we're literally going to see a straight line across our trade screen, really not giving us a clue what to do. So isn't that quite logical? That's one very logical example. But again, it holds construct, it holds its structure over using technical indicators. In developing a successful trading strategy, it is perhaps wise to use a combination of price action, technical analysis as well. This is because technical analysis does not outline some very good statistical observations in the markets. As such, price action itself will often trade very uniquely around technical areas of interest and can reveal indications thereafter of future price movements. So we're starting to build in the full picture here, guys. We can use price action, we can use our fundamental analysis of a trend and on why the market's trending up, what cycle is the market in, if it's an equity market, if it's a commodity. And of course, then we look at the price action in accordance with the technical indicators that we use to supplement trade decisions. Okay, starting to build in the full frame picture here of a trader. So developing technical methodology. Okay, so whether we decide to simply trade the price action or use technical analysis, we can ask many questions that will assist us in our decision making. One such question is, well, what price action or technical trading strategies can be used to develop trading methodology? Okay, I just want to touch on this as we go through at the start of this lesson, because we will devote completely a full lesson to developing trading strategy inside out at the very end of the Become a Pro course. So look forward to that. But in terms of looking at what we've learned over the last particular few lessons, technical lessons, and building upon this, well, we have a chart in front of us. We have the Euro US dollar daily price action chart. First of all, we have price action. Okay, is the price action trending or consolidating? Higher lows, lower highs? Is that what we're seeing in the market? Are there certain structures in the market? Is the unique momentum shown within these candlesticks? Perhaps there's an engulfing candlestick. This is stuff that we've all learned throughout the education here with the Become a Pro course. And then we look at the technical side. So perhaps is there a level of support and resistance? Is there an increase in volume? Is the market near Fibonacci retracement level perhaps, and does that give us an opportunity to get the bounce there or really supplement that market? Let's move on to actually looking at another market and just simply ask the same question: what price action or technical trading strategies can be used? And again, this is the Euro US dollar. So effectively, as we go across these trades, well, how do we trade this market? With the skills we know, with the technical skills we know, well, there we go. We only supplement our trading ideas with what we know how to use in terms of technical analysis. We can see volume, we can see trends, we can see very clear structures in the market. We have a triple top there on the left hand side and a very strong double top there. We have price channels, we have lifts there, a series of higher lows. Again, so all very basic technical analysis without actually going too far down the rabbit hole in terms of technical indication. Very well structured, is it not? Indeed, and of course, if we can use perhaps one indicator to say, let's say a stochastic oscillator, which we will learn about in this lesson, to say, well, there's going to be a shift in momentum, a strong shift in momentum to the downside. Perhaps it's looking to be overbought at these levels. Well, then that is, of course, going to be supplementary if we look to sell the market. Okay, it all depends, but that's how we look to develop technical methodology. So let's just touch upon momentum before we delve into the technical analysis of today. Okay, and I have a very nice quote that I enjoy here from our old friend Sir Isaac Newton. Okay, we're all very familiar with him, of course. Let's go through his quote. An object in motion stays in motion with the same speed and the same direction unless acted upon by an unbalanced force. An object in motion stays in motion with the same speed and the same direction unless acted upon an unbalanced force. Now, of course, Sir Isaac Newton was talking about gravity. He was not talking about the financial markets, but in terms of defining motion and momentum, it holds the same sensible construct. Okay, that is effectively what you see in terms of momentum. You see different from momentum indicators, you see trends. Well, using that hypothesis, well, if nothing else changes, or ceteris paribus in Latin, which simply means all things remaining constant, where is all other factors remaining constant, where is the price more likely to continue to go to if we're in a bullish trend? To the upside, of course, to the upside. So what we have here is our first technical indicator, and it's simply a momentum indicator. That's all this is. You can actually use this on the trading platform. Of course, just a very basic indicator. The momentum indicator shows the location of the close relative to the high-low range over a set number of periods. And this is effectively what we see. Down here on the left-hand side, we have chosen to use this indicator to the momentum of a 14 time period average. Okay, so we've chosen daily time periods to trade this market. This is what we see with this trend. That's the last 14 days. So we can use this sample 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So from this price point to the end, this is our relative figure here. Okay, that's simply all that tells us. It tells us that there's, well, now evidently there's been a bit of a downturn in momentum, and now just with the candlestick there, it just looks to bring it up in terms of more relative price action. Okay, that's effectively what we see with this point in time here. We see bullish forward momentum. Again, the market's trading up to the upside, nothing too strong in terms of the candlestick structure. We just get small bullish candlestick day after day after day. What we can see is momentum here is at a high of the range. Okay, so if we use an average perplexed point as well, we see that of course we have these technical levels way above the high of the range, and again it's moving to the upside from point A to B here. Okay, so very simple. That's simply by inserting your momentum indicator onto the platform, you can look to see where momentum trades. So I just wanted to give you that before we move into heavier stuff here, because we most certainly will. And really one of the most common and popular momentum indicators is of course our stochastic oscillator. You might have heard of this before, stochastic oscillator. As a principal technical rule, momentum is said to move before price. Stochastic is designed to give you an objective measurement of momentum. As such, it has preferential treatment to trading with the trend. So let's just take a breath, take a seat back here, and we'll just examine what we've just said. Well, look, we're looking to, evidently as traders, have a better idea of the future movement and direction of price. If momentum is said to move before price, shouldn't we look to analyze momentum? Well, that is absolutely the case, and that's effectively what the stochastic oscillator tries to point out. It is bound between the numbers 0 and 100 and will oscillate between these two areas. As the oscillator moves up and down between these ranges, it does not always track price movement. So it doesn't track price movement. It measures momentum via direction in that it tells you that the market is closer, higher to highs or lower to the lows over a set period of time. Okay, so is the momentum closer to the highs of highs as the market trades higher or lower to lows of the relevant price action? We are always looking to measure momentum as such, and there is really the equation to the stochastic oscillator here. This is actually the fast stochastic oscillator. There are two, a slow and a fast one, and again we prefer to choose the fast one. It uses the most sensitive price data. So here we have a bullish trend. Okay, now why have I decided to place bullish trend there in big green letters at the top of this chart? Well, because this is how best to use the stochastic oscillator, because what it effectively does, it shows you areas, of course, where momentum is trading or reversing or exhausting, and obviously you can look to fade those areas. Now, because we're in a bullish trend, of course, what we should try and do is trade the trend to the upside. Now, that's a little obvious, of course, but you might say, well, of course, there's opportunity to sell this trend as well. Well, yes, but if you're really looking to trade with stochastic oscillator, you're looking to trade in the momentum of price. So the momentum is to the upside because it's a bullish trend. Very obvious stuff. But again, let us highlight our opportunities here and we'll discuss why it's the best point in time. Okay, so first opportunity there, we have it down at these levels. So again, what we just suggested on the last slide is, well, this level, the momentum is trading to the downside here, continues to shift to the downside, and at this level it seems that the momentum has stopped at our 20 level and has exhausted, and now it's shifting to the upside. So at this candlestick, I would say here, this is our buy signal. And again, we can use the price, the candlestick movement of this price in one candlestick to say, well, let's take a position here, a long position here from the break of this candle. Okay, that might be a long-term trend. It might not. Let's move across the price action and point out other trading opportunities. Of course, the second opportunity there, what we see is, again, we get just a touch off the 20 level. It doesn't break our level. And there's a shift in the momentum again to reflect the market moving to the upside. It's effectively what we see in the overall trend structure. Can you see that? In the bullish trend, it turns in and around this 3-day period and turns to the upside. Now, that is effectively our momentum exhaustion. Down at the bottom of these ranges, the market is in a bullish trend. In the first instance, of course, it traded to the downside. I'll just highlight that on chart. What we actually see is the market reverse this trend a little, trade to the downside, but we don't want to get involved here. We want to get involved in the trend. And then the market effectively trades to the downside again. And again, we're just waiting for that momentum to exhaust. If it continues to go, well, then the trend perhaps may break. We don't want that. We want to follow momentum because it depicts future movement of price. We get the exhaustion at these levels, and again, in and around here, if we can find something subjective to the candlestick, in and around these levels where we see a reformation of the new trend to the upside, the momentum trend, the stochastic oscillator, of course. If we see something similar in terms of this trend, well, then that is our sign to make the trade, of course, to follow the direction. So it's trying to highlight, perhaps much like the RSI, which will describe overbought and oversold signals. You could say, of course, now this is not the intention of the stochastic oscillator, that these levels are effectively oversold, but instead these are suggesting to us, well, the momentum has exhausted at these levels and trades to the downside. And again, you could argue, well, what do we do at these levels? Well, let's take a moment and really reassess what happens at these levels. So what do we do at these levels? Well, we're not interested per se in trading these levels. We could, of course, look to say, well, if we've caught a trend way down here and we see something very strongly telling us to get out of the trend because the upwards trend is exhausting, we could take profit at these levels. In terms of entering the market, Obviously on the short side, you may be short-lived in the price action because we're in a very strong trend to the upside. So we forego these opportunities, okay? Because we're looking at momentum. This is not, of course, the RSI. We're looking to follow momentum. We choose to forego these trading opportunities because the best trades, and again, you should always be looking for the best trades as a technical trader, or to trade the stochastic signals to the upside if the price action accords with the trend. Okay, so I hope that makes sense. And what we can do then is add some more context into this stochastic oscillator. Let's look at a bearish trend here to the downside, okay? So what we see again is just a notation here just at our 20 level. So this will be of significance for us, okay? Just what this arrow is. This is of course significant, or 80 level, but because we're in a bearish trend, that is not what we're trying to trade. We're trying to trade the trend to the upside, and this is the dollar index. Sorry, trying to trade the trend to the downside with the dollar index showing that bearish activity over the long term. Again, this is effectively what we see. The bearish trend, I should have that in as bearish, excuse me. Momentum exhaustion in these areas, and that is in accordance fantastically with these areas right here. So these are our very, very consistent signals. Of course, what we don't get then when we reflect here, we don't get the perfect signal in the price action because we actually get trading up just a little. Okay, so that is again what we actually could look to say is, well, as this rolls over and closes here or moves down here with the stop just right here, perhaps we can wait a little to try and get the candlestick price action supplementary. This example number 2 here, is of course much more structured, much more better. The price action literally rolls over like this and gives us our signal with the stop intact, with the momentum exhaustion intact. And of course it just continues to trade to the downside until new levels, okay, nominal levels. So again, great trading signal there. And again, what we choose to do, guys, is simply forego possible bullish price action, or possible bullish activity here on the stochastic oscillator, because we're looking for momentum. We're looking to find that momentum in the markets. We're looking for the best time to enter the momentum to the downside when the market pulls back. So effectively, it's very easy. We want to be short. This market is trading down. How do we do so? Well, we wait for the pullbacks so that we're not simply selling the market while it just the next day it moves up against us. Unfortunately, we're waiting for small pullbacks in the market, using some technical indications to support that decision, and then of course we trade as such. So we prefer not to trade on these signals here when the trend is bearish, just like we prefer not to sell the market when the market is moving to the upside in a bullish trend. So let's move on then to discussing average true range. Range refers to the high to low range of a Japanese candlestick of any time frame. Okay, it is described as true to account for the full movement of price, even when the market experiences gaps. Okay, so the full movement of price. As the Forex markets are nearly open 24 hours per day, we get daily gaps mostly on Sundays, when Asia is the first session to open after Friday New York's close. Although we do sometimes get gaps on other occasions. And what I would say is more particularly that the Forex markets are considerably high in volume. They are a very, very liquid asset class, of course, and we do see more often gaps occur in other markets such as equity, single stock equity markets, and equity indices. When considering the ATR, or average true range, as an indicator, it is important to view the price action as it reacts to increasing or decreasing price range. So I'm going to reiterate this as we go through our technical analysis here. Important to view the price range, and important to view the price action at such a range. So what we have in front is the S&P 500. The first thing we notice is that we're in this bullish trend again. We have more price uncertainty with the Japanese candlesticks and higher ATR. So is that very visible to all of us? Okay, I'll just highlight that in green here. The candlestick here is, trading to the upside here in this candlestick. Again, it just sits for a while, gets a bit of volatility, trades to the downside. Again, this shows us some more volatility, trades to the downside, trades to the upside in the next one. Effectively, we're not moving too much in price. This is our average price, say around here or even below. However, there's volatility there. there's average true range factor. Okay, the more prices that the market trades, the more volatile it is. And this is reflected right here in our ATR signal. Okay. Now, what happens in this market is quite peculiar, quite observed as a technical trader. You actually start to see the volatility leave this market or dissipate in this market, like here. And again, this is over the 5-day average. So each signal is from the previous 5 samples, 5 days in this case. So as the market trades to the upside, you effectively see this trade, the ATR signal trade to the downside or show a dissipation. Okay, so very interesting indeed. What we have is that lower ATR is significant as prices increase with potentially less volume. That tells us, guys, that this market wants to go one way. Okay, there's nothing necessarily driving it in terms of momentum. There's not a lot of volatility in the market. The market's simply ticking up day after day, and we get a very well structured trend. And this can happen in a lot of forex pairs that aren't experiencing a lot of news flow. That will really be, now I don't want to get into too much fundamental analysis, because this is really a technical lesson. But if there's not a lot of news flow or interest rate activity or whatever, big factors that may affect a forex pair, what you'll usually see is a market just tick up or down. The forex pair is literally appreciating or depreciating, really as a result of trade flow, which we discussed, whether there's a trade surplus or deficit between those two nations, and the market will just follow its rhythm. Okay, so this is quite interesting what we're seeing here with the average true range. Actually, the volume is leaving market with the ATR, and the trend is continuing. And of course, this is a signal to let us know that there's going to be more or less volatility in the markets, and then we, I suppose, objectively react to what we see as a technical indicator if we want to trade some markets. So let's move on then to discussing the relative strength index. Okay, and it's quite a common indicator. People like to use it because it gives you value signals, of course, and it can help you, I suppose. Traders do like to try and buy the bottom of a market or try and sell the high of a market. So if you're interested in that, of course, it's quite difficult to do. This is one signal that can help you. So the RSI, or Relative Strength Index, compares the magnitude of recent gains to recent losses in an attempt to determine overbought or oversold conditions of security. The range of the RSI indicator is from 0 to 100, whereas an indication above the 70 level is deemed to be overvalued and is a good candidate for a pullback or reversal. Okay, so an indication above 70 is deemed to be overvalued and is a good candidate for a pullback. Likewise, if the RSI approaches 30, it is a good indication that the security is getting oversold and therefore likely to reverse. The market has sold the security too much. Traders will often use the RSI as a partial signal to enter a trade. Okay, now this is one indicator that you do need to take with a pinch of salt sometimes in terms of understanding your market environment, of course, and understanding, if there's going to be a huge economic shift or something, that we leave some of these indicators to the side for the moment. And I'm referring, of course, to the recent equity market sell-off. Of course, we were at all-time highs and we had a 7% correction in the S&P. So that is quite significant indeed. And obviously, you would get the signal there that this market was oversold, but it would continue to go many further prices. So we have our critical points here: 70 at 30, 70, providing us with the overbought signal, and 30 providing us with the oversold signal. Again, it's more significant if it breaks through those levels, but if it touches these levels, again, that is what we look for, of course, as well. They're significant at a touch of price. So let's observe this, and what we have is the US dollar loonie, or the US dollar CAD, up on front. How would we like to trade this just according to the relative strength index? Well, we can see we have many trading opportunities here, so we'll walk through them in a little detail. Is this the first one a good trading indicator? Well, we see it's just trading at a mean, roughly a mean. Then the RSI trades down and it touches and breaks our signal here, our 30 signal, excuse me, right there. That is the perfect signal. The price action is perfect for that relative strength index signal. Okay, why? Because, well, we get a very strong move down. The low of it is right at the day, so that gives us the perfect opportunity. Again, if we buy that candle or the next one, of course, we can look to follow this opportunity as the RSI moves up with it. So that's a perfect signal. Number one is a perfect RSI signal. Okay, technical analysis stacks up, Japanese candlestick structure verifies that, and the price moves away. Let's move on to our next trading opportunity. Of course, we get a sell signal here. This market is overbought, and again, it's past our 70 mark, so it has breached the area. And again, it does indicate it a little early in terms of maybe this candlestick here, and perhaps this one. But effectively, if we were taking a trade in and around this area, that is a perfect trade. We get the effective selling of the high, of course, but price doesn't move down too much. And of course, what we effectively see is the RSI showing some concurrence with how the market is trading within this little range, I suppose, of the relative strength index. Nevertheless, it's still a good signal, and we'll take that one off. Take these first two off as good trading signals. Signal number 3, well, it's a little dysfunctional, I would argue, because we get the break of this level again at a 30 level. Again, that's in and around this time period here, so we get a very short trend to the upside. Again, it's indignified there, so it still holds weight. However, the market trades down below that low here, so effectively that's a poor signal, and the RSI stays above it. So effectively, we don't know what to do if we're not in the trade, of course, and we get long here. Well, that is a good signal, so we'll take that one. Okay, but again, you can see the ambivalence here. You can see the ambiguity in some of these markets when you're looking to trade one particular indicator. They give you the best signal ever sometimes, and of course, not so good signals other times, giving you false signals, of course. So a couple of good trading signals. We'll give that one a miss for now, I suppose. The next signal, again, I will certainly give a miss just how it trades. We get here right up, and effectively the market trades down for maybe one day and trades straight up to new highs. So effectively that is not a good signal there, and we'll take that off and just X that one. And again, we have the next signal as well. The market doesn't come down, it just feasibly just looks to touch this level, albeit it's around 35. So we can look to say, well, in and around this area, if we judge the price action, we should be able to get a trade off, and we do. We get one there. So it does follow the price up, and we get a decent enough trade to the upside, albeit short-lived. Okay, so I'll give that one a moderate tick, but that will be quite a discretionary signal as well. So just to recap, we have a couple of great trades, we have a poor enough trade, another poor trade, and again a 50-50 trade will go X and a tick there. So effectively what you see is, two good signals, two bad signals, and one we're not so sure about. Okay, just considering where the level is. So some great trading there, some not so good, but this is going to be the main construct of many of these technical indicators and how to use them properly.